Global financial markets remain cautious after a number of concerning events that was triggered by the collapse of Silicon Valley Bank, which American media claim is the biggest bank failure in the US since the 2008 financial crisis. So what led to the failure of Silicon Valley Bank? What are the broader implications of the failures of US regional banks? And what measures are being advised to better contain the banking turmoil? Welcome to Issues and Insiders. Today we address the concerns in the banking industry over in the US and in Switzerland and its broader implications. For this, I have Professor Greg Buchak from Stanford University here in the studio. Professor Buchak, it's a pleasure to have you with us.
Thank you for having me.
Right, I also have Professor Kim Yong-jin from Sogang University. Professor Kim, it's been a while. Welcome back.
Yeah, good afternoon.
Right, Professor Buchak, we'll begin with you then. Let's start off with the events leading up to the failures of Silicon Valley Bank as well as Signature Bank over in the US and perhaps the current state of affairs.
Sure. So this is all taking place in the context of central banks around the world raising interest rates in order to combat inflation. And that's causing a lot of problems at banks. So what the typical bank does is it raises short-term deposits and uses that money to make long-term investments. Now the problem is that when interest rates rise, the value of those long-term investments decrease. And if the depositors get a little nervous, they may try to take their money out of the bank very quickly. So like Korea, the US has deposit insurance. So it covers an amount of what's deposited up to a certain amount. But above that, it's not covered, and so these depositors face some risk. Now, this is sort of a problem in the US banking sector overall, but some of these issues were particularly acute for Silicon Valley Bank. And so what was going on is Silicon Valley Bank had a particularly high number of these long-term securities that were losing value as the Fed was raising interest rates. At the same time, Silicon Valley Bank had an unusually high amount of uninsured depositors. And this was because they were sort of the bank for a lot of these tech companies in Silicon Valley. So these tech companies would have their money, they'd have the money that they were using for sort of business purposes, to pay their employees, and they had millions and millions of dollars in the bank. So everyone sort of woke up to what was going on at Silicon Valley Bank. The depositors got a little spooked, they yanked the money out. And that prompted what sort of the government ended up doing in response. So the first thing that happened is the FDIC, which is the insurer for typical deposits, they stepped in and they sort of went around affecting a sort of orderly unwind of the bank for the insured depositors. That's a very normal thing. That's kind of the standard process. What was very unusual here is regulators took this sort of extraordinary action of designating Silicon Valley Bank to be systemically important. And what this meant is that the Treasury and the Federal Reserve essentially backstopped not only the insured deposits, but the uninsured deposits as well. So sort of what ended up happening is the equity holders of the bank, the owners of the bank, they got wiped out. The depositors of the bank, both the insured and uninsured depositors, they were made whole. So they got their money in the end. Now, what happened at Signature Bank, sort of similar. So what they had problems on the asset side of the bank. Their assets were declining. This was a bank that their problem wasn't so much the rising interest rates. They were a sort of lender to a lot of crypto businesses. And as you may know, a lot of these crypto businesses have been struggling recently. So those assets were performing poorly. And then as a result, depositors yanked their money out.
Right, I see. And Professor Kim, concerns over the banking sector, they're also quite evident over in Europe amid the crisis surrounding Credit Suisse, which I understand now, of course, the Swiss banking giant UBS has offered to buy it for more than $3 billion US. What's the latest on that front over in Switzerland?
Well, as you mentioned, Sonny, the biggest Switzerland bank, UBS, agreed to buy its ailing rival bank, Credit Suisse. It's a kind of emergency rescue deal. And this deal was agreed after days of negotiations among the regulators in Switzerland, US, and the United Kingdom. And then this UBS is paying $3 billion, 3 billion in Swiss franc. That's about 3.28 US dollars for Credit Suisse. It's about 60% less than the bank is worth when the market closed on last Friday. So they lost almost all the values, right? The deal will not need to approval of shareholders because Swiss government agreed to change the law so that they can remove all the uncertainties in the deal. And the Swiss National Bank also announced that they will give 100 billion Swiss franc loan to these two banks, UBS and Credit Suisse, to boost up the liquidity.
Right, and amid these efforts to shore up these banks or to better deal with the ripple effects, Professor Buchak, there are growing fears about a potential broader financial meltdown. Do you share these fears?
Well, they're sort of reasonable. The issues that were affecting Silicon Valley Bank, as I said, they were particularly bad for Silicon Valley Bank, but they really affect the banking system overall. Banks own long-term assets, and the value of these assets has been declining as central banks have been raising interest rates. Now, this is a particularly bad problem for the banking system. As you may know, banks have a very low amount of equity or very low amount of capital. It doesn't take much losses on the asset side to wipe out a bank and cause a bank run to happen. Now, regulators have been sort of taking steps to try to shore up the banking system. One big thing is that when the Federal Reserve and the Treasury jumped in to save the uninsured depositors in Silicon Valley Bank, I think they kind of sent a message to the market overall that the government will backstop some of these uninsured deposits. So that relieves a lot of stress. There's a lot of issues that come along with that, but it allays people's fears. Another thing that the Fed has been doing is they made available a sort of lending facility so banks can borrow money against their long-term assets at par value. That helps them sort of acquire cash if there's some emergency and they need to meet these cash withdrawals. Now, these things I think can help. I'm not sure if they address the underlying issue, and I'm not actually sure there's so much the Fed can do or wants to do to address the underlying issue. These actions that they've taken sort of shore up liquidity, so the banks are able to get cash when they need that. That doesn't really address the underlying solvency issue, where the assets of the bank are worth less than the sort of the debt that the bank has. I think we'll have to see what happens. I wouldn't be too surprised if some banks suffer more as a result of this.
I see, so only time will tell then. Mm-hmm. Professor Kim, Goldman Sachs, in the meantime, has forecast that tech shares here in South Korea and over in Taiwan will be affected by the failure of Silicon Valley Bank. Could you explain that for us?
Well, according to Goldman Sachs, they think the stock prices of tech companies in Taiwan and South Korea have over-delivered. That means, the stock price was too high and was not adjusted, even though there's a failure of two banks in the US and also Credit Suisse. But what the Goldman Sachs reported, this sector, the tech sector in Taiwan and Korea, are pretty much vulnerable to the economic condition of the US and also economic growth of the US. So it should be affected, sometime later. I mean, they have to be adjusted. Also, the benchmark for South Korea and Taiwan have not been adjusted. It fell in less than broader MSCI, the Asia Pacific Index. So basically, what they believe, even though there are kind of sensitive issues, and then Korean economy and Taiwan economy might be very affected by the economic condition of the U.S., but it was not adjusted that much. I 100% agree to that ideas, because the Taiwan and Korean tech sectors rely heavily on export to the US and the EU. So the economic crisis or financial disruption in these two markets would absolutely 100% affect the Taiwan and Korean tech sector.
I see, hence the concerns here in the country as well then. Professor Buchak, the failure of Silicon Valley Bank as well as that of Signature Bank, it's sending a bit of pressure, if I may, on the US Federal Reserve, calling on it perhaps, indirectly if I can say that, to dial back on its interest rate hikes despite the high inflation there in the US. What is your outlook with regard to the Fed's next move?
Yeah, it's a good question. I think it's important to think about the broader economic context here, which is if you look at the real side of the US economy, unemployment's very low, GDP growth is good, the economy is pretty healthy. What the Fed has been concerned about for the past year or so is, as you mentioned, inflation. And the main policy instrument that the Fed has is raising interest rates in order to slow down investment. So that's really what the Fed wants to do, slow down investment. I don't really see what's going on in the financial sector as really impacting the Fed's overall goals. It's going to make them think about how to affect those goals in a different way, but sort of where I see this going is the Fed is still going to be concerned about inflation. That's still going to be priority number one, and they're going to do what they can to keep the financial system as healthy as it needs to be, insofar as it doesn't impact the health of the broader economy. Remember, the Fed's mandate is not to make sure the bank equity holders are comfortable, it's to care about inflation and unemployment. Now, where I do see this perhaps changing the trajectory that the Fed is on in terms of interest rates is the Fed may look around and say, you know what, the financial system, the banks, they're going to be a little more concerned, they're going to be a little more conservative when they make loans. And you know what, that's exactly what the Fed wants to do. Because the banks might be a little more conservative on their own, the Fed may be able to ease off rate increases a little bit. But again, it's not because I think they're going to be prioritizing the health of the financial system, they're doing what they need to do to tackle issue number one, which is inflation.
Right, and back here in the country, Professor Kim, the Bank of Korea, it's set to share its new policy rate on April 11th. And that being said, what look to be the implications of the Fed's action on Korea's future policy direction?
Yeah, typically, when the POK Bank of Korea decide the benchmark rate, interest rate, they consider three things. Number one is inflation rate, or CPI, Consumer Price Index. And number two is U.S. Fed decision on the key interest rate. Number three is Chinese economic condition. Now, but they have to consider more things. They have to consider financial instability caused by this kind of banking disruptions. It's more complicated, but like Greg mentioned, they have their own mandate, their goal. They have to stick to the principle of tackling inflation and also financial stability. But here we have another problem. If U.S. Fed raise, 25 BP or 0.25% of benchmark interest rate, the gap of the interest rate between the U.S. and Korea increases by 1.25%. Which might cause huge problem of managing foreign currencies. This is a dilemma which Bank of Korea face. But I believe Bank of Korea will decide to raise 25 BP base point this April 11th.
Right, I see. Professor Buchak, the European Central Bank, for its part, opted for a big step. It raised its benchmark interest rate by 50 basis points last Thursday. How do you explain this particular move?
I think what the problem that the ECB is facing is a lot like what the Federal Reserve is facing, which is the European economy is doing pretty well. Unemployment is relatively low. GDP growth is pretty good. And they're concerned about inflation. And I think they're raising interest rates in the way they did, even looking over at the US and seeing what's going on there, kind of speaks to the idea that they're going to keep on that goal and they're going to manage, and they at least think they can manage the financial fragility that may result from that.
Right, I see. Professor Kim, on a different note, some pundits believe the failure of Silicon Valley Bank will push mortgage prices down, mortgage rates, that is, down. Also here in South Korea. Could you explain that for us?
That's very interesting phenomenon, right? And then almost all people might be surprised to see that. But when we think about the very nature of the cost of funding a bank, it makes sense. So typically when banks raise funds, there are three costs involved. Number one is their regular savings and installment savings rate. And their own commercial paper means a bank debenture rate. That is the second thing. And the third is the key interest rate. These two, bank debenture rate is already going down, and also the regular savings and installment savings rate is going down. Now, if the U.S. Fed takes baby step, means 25 BP raise, then again the key interest rate is stayed low, or as expected. So basically, the cost of funding for the banks are going down. So, the mortgage rate should go down for a while.
Right, I see. Professor Buchak, speaking within your capacity as a scholar perhaps, who is observing these events as they unfold, do you perhaps believe the failures of Silicon Valley Bank or Signature Bank could have somehow been prevented?
I do, and unfortunately my prescription is not very popular with a lot of people in industry. Really the problem is that the banking system is dramatically over-levered. And what we need to do is reduce the leverage of the banking system. And let me explain what I mean. If you go out and you look at a sort of regular business, maybe they're like 50% debt, 50% equity. When you look at a bank, that ratio is something like 10 debt to 1 equity. They have a lot of debt, a lot of that is deposits. Now what that means is when the bank has a very small loss on the asset side, they burn through that equity really quickly and put a lot of the depositors at risk. Now why do we have a system like that? It's because we have a lot of sort of implicit and explicit government guarantees and subsidies around bank deposits as being their main funding source. Now, what I would like to see, and what a lot of my colleagues would like to see as well, is changing these capital requirements. This is the requirement that says how much equity does the bank have to fund itself with. Right now, that number is about 6%. A lot of people, including me, would argue that number should be something like 50% or even more, a dramatically higher number.
Banks would not like it.
I know they wouldn't like it.
Which is why he's so quite unpopular.
It's very unpopular, but think of what would have happened with Silicon Valley Bank if that had happened. Asset values would have declined a little bit. Equity would have lost a little bit of money, but the depositors would have been safe. There wouldn't have been a bank failure. There wouldn't have been any need for government intervention in this. And by the way, because the equity holders are on the hook for all of this, they would have been able to sort of take appropriate risk controls. They would have had good incentives to run the bank in a safe way.
Right, I see.
Now, as you mentioned, the banks hate this. They hate it because they would lose money. And they also make arguments like, well, if we have to raise more capital, then there'll be less lending in the real economy, or people won't get grandma won't be able to get her mortgage. Now, I sort of think that a lot of these arguments are not very good. Now, one of the arguments that they make is that capital is very expensive to raise compared to debt and equity. But if you think about it, the reason that debt and equity is so much cheaper is because the government has decided to subsidize these deposits through the guarantees that we see going on in Silicon Valley Bank. And some of my own research sort of makes the point that a lot of what banks do is really not that special. So if you go out and you look in the US, a lot of mortgage lending is coming from financial intermediaries who aren't banks, who have a lot of equity. They're able to provide these services to people without this extremely fragile funding situation. So that's what I would like to see, dramatic recapitalization of the banking system, although I think that's a little bit wishful thinking.
Right, I see. Professor Kim, then, what are the risks of perhaps a similar scenario taking place here in South Korea?
Yeah.
Our banking industry here, and what would be some potential preventative measures to thwart such a scenario?
Yeah, well, a lot of people think, we might have similar crisis, to the U.S. and Credit Suisse, but considering the fact that the asset and debt structure of Korean banks are quite different from those of, U.S. Bank and Credit Suisse. I mean, Korean banks do not take a lot of risk. They just focus on safer loan businesses. But it means Korea, we have lots of loan demand. And Korean banks have a lot of deposit. They spend all the deposit for the loans. So basically, the rate of deposit to loan would be almost 100%. So, like Greg mentioned, if you have short-term deposit to invest in long-term asset, then in this kind of interest rate increasing situation, you will lose. But Korean banks would not have that kind of risk much. But problem is, as you mentioned, as you know, the household debt in Korea is extremely high. Now, after the COVID-19. A lot of household default, borrowers default rate increases. This is the key risk Korean banks would have. So Korean government, and I agree to government ideas, basically Korean government asked banks to put aside more capital for countercyclical capital buffer and also this kind of stressful situation, right? Stress capital buffer. Minimum 2.5% to maximum 9%. That's huge. So banks are kind of now complaining a lot about that. But this is a basic measure to secure safety in our financial systems.
Right, that is here in South Korea, of course. Back in the US, Professor Buchak, which other banks perhaps are coming under scrutiny in the US? I mean, is First Republic Bank in safe territory now?
I don't know about the specific numbers for First Republic Bank. A lot of what people have been talking about are these sort of regional banks where there's maybe less confidence in the stability of their deposit base and so on. And something you may have seen in the news is a lot of deposits are flowing out of these small regional banks into much larger banks. And there's a sort of concern of sort of antitrust issues. Do we really want JP Morgan grabbing all of these small banks' assets? I think we'll have to see, we'll have to think carefully about that, whether that's a banking system we want, where there's a lot of failures of these small guys. But yes, it's the small regional banks that are raising a lot of concern now.
Right, and against that backdrop, Professor Kim, what are your thoughts on the risks of a recession amid this particular banking turmoil? Do you suppose the risks have been raised?
It's been already, starting. I mean, we are already in a recession period, and also, like you mentioned, like you see, we have those kind of problems in project financing areas, or the household market and the housing market, and manufacturing. They have a lot of inventories. If they put more inventories, they are at risk of default. Even though they have, in the book, they would have, a big profit, but still they lack of cash flow. So this economic recession, we see, I don't know, but at least next year, or one more year, 2 years. This we also see, but this is different from the U.S. and Swiss credit bank. We have like a small banks which put a lot of their loans in the form of project financing. These got rotten, then we'll be in big trouble, and a lot bigger recession we have to face.
Well, I'll keep my fingers for that not to happen. I see. Right then, on that note, we'll call it a day. Professor Kim, as always, thank you very much for your time and your thoughts. And Professor Buchak, it was a pleasure having you with us.
Thank you.
Right, well, on that note, we end Wednesday's edition of Issues and Insiders. We return same time tomorrow, that is Thursday, to discuss the latest events in the K-pop industry. Join us then. Thank you for now.